Hello everyone, it's Thursday, July 13th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are live from Chicago tonight. And what a full night we have for you. Lots of interesting topics, brand new segments, and we hope you're going to enjoy yourself. We got a lot to talk about. Let's get to it. AI and you, artificial intelligence and you, how will it affect you, your future, your kids' future, your grandkids' future, and then the next 10. That's a really cool short segment that I'm excited to introduce to you tonight. All right. So you guys know what this board looks like. A little different now. We've got the monthly review, U.S. policy. I've mixed up the order a little bit here so it makes more sense. At least I think it does. The Fed, inflation and recession, whether we're going to have one or not, U.S. housing, employment, economic indicators, AI, the formidable future, the next 10, and then our investment methodology. If you guys aren't following me, anybody that's new on the show, be sure that you click the subscribe button, click the little bell so that you get notified whenever I go live. I also tweet every single day, and that means I tweet not just to Twitter, but to Facebook and LinkedIn. Interesting, our LinkedIn audience is probably our largest one, so join us on one of those three mediums and keep up with us. If you want to plan ahead, next show is Thursday, August 10th. Now, the September show is going to be different, and that's what I'm going to tell you about right now. Those of you that used to attend our financial fireside chats, remember that I started them in the summer of 2008. All right, 2008. This is the slide that we use to commemorate our 10-year anniversary. If you look in the top banner, you'll see a 15 that's going to be there through next January. Why is that? The chats are back. We are back to doing live fireside chats. COVID's done. I'm back in Chicago. The first one will be in September. Those of you in Chicago, or if you want to come in from Florida, South Dakota, New York, Montana, wherever you are, even Ohio, join us at the Batavia Library, the Founders Room. This is where we've done so many of these chats to celebrate our 15th year. So it's 15 years of a combination of the Fireside Chats and CB3 Live. Obviously, we stopped doing live Fireside Chats during COVID. We started this program to which many of you have been to for the first time and didn't really even realize that we had those Fireside Chats. So there's a little bit of history on the screen, and you can see what it's like. We'd love to have you there. The monthly review. So historical data shows us that the third quarter of any calendar year is usually the most difficult for asset appreciation. That means this quarter we're in right now. The upcoming earnings season will likely hurt stocks, according to 55% of the respondents to the latest Market Live Pulse survey. It's down in the footnotes if you want to check that out. Really? Now this is where I have to chime in. This is why you guys watch this show. I read the data. I don't read the sentiment out there, because the sentiment is always going to be bearish and negative, because that's what gets eyeballs on the screen. Let's look at the real data, okay? A lot of people expecting earnings gloom. So when we start the third quarter, we're actually looking at the profits of the second quarter. So that would be April through June, right? And here we are in July. It'll continue till the end of August, and some of them dribble into September. And then we start all over again in October. So profit warnings, both professionals and retail investors, more than half think that we're going to have profit warnings. I am not in that crowd. And in fact, the top 10 contributors account for roughly 12% of the S&P's roughly 16% year to date. That's actually late. I didn't update this slide. It's more like 16.5. We've had two really good days. We're going to get to that in the CPI section. So these 10 stocks, what are these guys? So of the top 10 stocks in the NASDAQ, they contributed 30 of the 36% gains. That's more like 37 right now in the index year to date. Now, UBS, big firm, have rated these stocks. 57% of them have rated, buy ratings. Only 43%. So a neutral at 57 and buy ratings at 43. And this is exactly the point that I'm making. These analysts come out, they do their research, they say, this is who we think is going to fail, who's not going to fail. And they're just guessing, because then there's this blackout period where they can't talk about anything. And then when the actual earnings come out, they're most often better than they are expected to be. All right. But this last 2 quarters, the top 10 stocks in the NASDAQ are contributing 30 of 36% of the gains. But what the market has shown the last couple days is that it can succeed and rally even without technology. Now, most of you know the technology sector is the largest sector of the 11 sectors. And if it's failing, it's pretty much going to drag everything else down with it. But if it's just coasting along and money is what we call rotating from technology to financials to communications to consumer discretionary, that's a good thing. We want a broad-based rally. That's how a strong secular bull market continues. That's what I've been predicting since the low in October of 22. And so far, that's what we're seeing. All right. So throughout the 21st century, it sounds strange to say that, it's 23 years, but let's face it, it's here. The percentage of companies that have beaten consensus earnings estimates, it's greater than 80%. Greater than 80%. Now, some of you who see that slide that I put on here every week, I didn't put it on this show because I used this slide instead. And 80% beat includes the NASDAQ, includes the Russell. So that chart that I normally show you is only the S&P 500. So you can see it tick down, 30 stocks reporting, 60 stocks, 200 stocks. And basically, that's what the S&P is doing, 73%. But when you add in the more aggressive sectors, it gets up to 80% of stocks beating projections. And that's a great number. All right, read the data. That's what matters. U.S. policy. So why is U.S. policy important? Politics leads to policy. Policy leads to personal impact. Personal impact leads to portfolio impact. All right. So here's the squeeze from the top. And this is something I'm watching because it's very real and affecting the net worth of America. Look at the Bush administration, Obama. Now, Obama came out of the recession that Bush basically left office in 2009, right? Continued on. Trump had significant success, at least during his administration. And then it's been a little tough during the Biden administration. And why is that? Folks, that's almost entirely due to inflation. Now, I know that those on the far right want to blame Biden for everything, President Biden for everything. But the reality is that if we had 10 or 11% inflation in this country, or 9, which is, I think, what it was almost a year ago, and the rest of the world had 2.5, then we could say, okay, that's definitely a problem here. This is a global issue. Now, why did it happen? That's a long story, not part of what I'm going to cover tonight. But the reality is, this squeeze from the top, reducing net worth, is something we are watching where politics affects policy and affects our personal wealth. So this is going to be something I posit to you. I think it's important that you understand my perspective on what I look for to influence our portfolio. So at this moment in time, the world pivots around the U.S. That's no surprise to you. We are the world's largest economy, the most powerful military force, and boasts the most powerful geographic position. Why is that? We don't face any threat on land. The chances of Canada and Mexico invading us are 0, and there's no nation with a naval capacity to invade us. We therefore face no existential threat. We have the greatest room to maneuver, therefore plotting our course with fewer ramifications and more easily recovering for consequences when we face them. And that helped us, it enabled us to fight off 2 enemies in World War II, Japan and Germany, really the Axis, which was more than just Germany. It was Italy and the other nations that Germany swallowed up during that time. But our geographic position helps us. I monitor that because I think it's important to understand where the next innovations are going to come from, and do we have protection from those trying to invade us to essentially impede our technological progress. We're in a pretty good, safe position, and I think you can see that from what I'm showing you. All right. The way countries interact is shaped by necessity, be it economic, military, or political, and you're seeing this with Russia and Ukraine. Why do I say that? Between countries, their interactions may be hostile, or they may even be cooperative, but interact they must. That's what you saw when Russia was negotiating, bombing Ukraine in the morning or one week, and then the next week discussing and negotiating a wheat export deal. It seems ludicrous, but the reality is that we interact, and we have to continue to interact and negotiate. The world then is a kaleidoscope of conduct, the significance of which is constantly changing, and this has portfolio effect. The task of the moment is to make sure that we can make sense of these patterns to better understand the future. Now, I want you to understand them to the degree that you want to, but I have to as a portfolio manager. And again, when it gets to politics and wars, I don't want to be insensitive to the fact that there is an enormous human cost in this. But my job as your portfolio manager is to stay out of the way of risk, but look for opportunities to still prosper even during times of geopolitical angst. And I think you'd agree with me that that's what we are in right now. All right. So the world has 3 major forces. China, which is trying to emerge from centuries of external and internal friction, now confronted with the question of whether its progress is sustainable. I'll show you a chart here in a few slides that's going to say pretty concerning for China. Russia, a one-time global power that seeks to recover from what it lost in the 1990s. For those of you that have forgotten, Mikhail Gorbachev and Ronald Reagan had a peace pact which essentially undid the Soviet Union. I mean, they just fell under their own weight. And so all of the states that were part of the Soviet Union have fragmented, many of which, or several of which, have joined NATO. And that has psychologically weakened and even commercially weakened Russia. And that is what Putin is trying to return to. And of course, Europe, which is trying to piece itself back together. But here you have a situation in Europe, the European Union, where you've got one of the Irelands that's in, one of the Irelands that's out. You've got two Scandinavian countries that are in the European Union, but Norway is not. I mean, they're just fragmented. All right. And Germany continues to be the big dog that's wagging everything else. But Germany has its own problems in how they deal with immigrants, refugees, etc. It's a very complicated mess. Again, they don't have the geographical isolation that we do. And I think to some extent, because they spend more time thinking about their survival, less innovation comes from these parts of the world. Again, our isolation blesses us and allows us to focus on things like economic and technological innovation. So see if I got any misses comments here. Hey, Debbie, how are you? Hey, both Debbies, Debbie D and Debbie B. Glad to see you guys. So the Fed, Jay Powell, poor guy. I tell you, take a time out, Jay. You really just got to take a time out from these rate increases. That's what everyone is telling you. And I understand when you take the pulse of what's going on in the country, that's your job. Your target is inflation at 2%. Your target is maximum employment. And right now, those two are working against each other. All right. What does that mean? So the Fed sets Fed funds rates, which sets the short-term interest rate. And their target is, this says 5.25. I think they're going to go to 5.5 later this month. And I think that's the last raising of interest rates. I think it comes down after that. It may stay flat. Look at that period of time, all right, from 2006 to 2007, where it just stayed flat up there. It stayed very low from 210 to 215, stair-stepped up and then stayed low again. We could stay right here at a 5.25 or even 5.5 interest rate so that inflation can drop from 4 to 3 to 2. We'll get to the inflation section in just a minute where I'll explain more to you. But Chairman Powell and his peers more or less admitted, and that's why this is in red, they don't really understand what's happening right now. Not what you want to hear from the Fed chairman, all right? As they are in, by their words, the final stages of their battle with inflation. They couch that message in a positive spin. And let's face it, it's great that the economies have proven resilient, not just the U.S., but world economy, since the Fed started tightening. And it's definitely a surprise that the U.S. unemployment rate remains so low. We'll get to that in the employment section, especially with all these headwinds, I should say. But Fed speak, this is my interpretation. It's not what we would have expected. They say, well, we're not totally sure why the economy hasn't tanked after the biggest and fastest rate hikes in more than a generation. Let's look at this again. Look at the steepness of that curve. So again, as your money manager or your commentator, for those of you that aren't clients, what is up the sleeve of the Federal Reserve? It's my job to understand what that is and invest accordingly. Obviously, I would like to know what they're going to do up ahead. I don't think they know what they're going to do, whether they're going to raise in July, and if that's the last one. I can tell you that the market is expecting it's the last one just based on the CPI data that came out yesterday. If you've watched the market, you've seen two very large up move days. It's been really good ones for us. So
the idea of...
Whoops, sorry. Let's go backwards. All right. So this is just a funny thing that I put in here. We always talk about the effects of what happens in the economy. Do people really pay attention? I saw this on Twitter. Son, I got a new job. Mom got a raise. We have more cash in the bank. Gas prices are falling. All of this is true. It's really happening. My 401k is up, and your 529, that's college savings of those for you who don't know that. And my company's expanding thanks to growing profits. But we're not going to Disney World because the yield curve is inverted. Said nobody. All right? The truth is, those comments were made by some political economic pundit on one of the networks saying, this is why you need to be concerned. Is it going to keep you from going to Disney World? Is it going to keep you from adding on to your house? Is it going to keep you from going on that Alaskan cruise? It is not. And you'll see later in the program why U.S. consumption is so strong. I've already laid the framework for that, just talking about the political structure of the U.S. in relation to the other countries in the world. All right. So inflation, is it heading down? I think that's a pretty good data point to look at right now. And I think I can show you conclusively that it is. So expectations, let's not talk about the actual inflation, but the expectations dropped to a more than 2-year low in June. And the outlook over the next 5 years improved slightly. Okay, that's good. Consumer sentiment rises to 63.9 from 59.2. Now, You've been watching this show for a while. You know why consumer sentiment is so important. 2/3 of all GDP, gross domestic product, is generated by consumers. The rest of it is divided between government spending and corporate spending. Okay? With increasing efficiencies, corporate spending may continue to either stay the same or even drop off. We hope that government spending is not going to increase, but we all know it will. But the reality is, if consumers are spending, we are in great shape. And when the sentiment is good, it means people are thinking, okay, things are going to be good, and I am going to keep spending. So this is what consumers are seeing if they're watching the data. This is straight from the Labor Department. Core inflation, 5.3 and heading down. Overall inflation, 4% and heading down. What's the difference between core and overall? I've talked about this. One removes energy and transportation. All right, and that's because, and food, those three components. All right, so why does the core do that and the overall inflation drop further? So energy and food are very volatile components of consumer price index. So the government likes to strip those out because they know that they can be mercuric, word of the day, mercuric. All right, I look at both. I do place a bigger weighting on, unlike the government, on what's happening with energy and food, because you need to drive and you need to eat. So you can exclude those if you want to collect the data and say, well, this, I can't really trust this, but people are living on those items. So I need to know what those are because it affects spending. If it affects spending and people can't buy things, then companies' stocks are not going to go higher because their widgets aren't being sold. This is the mindset of a portfolio manager, okay? I don't know why my system is triggering that slide there, but anyway. All right. Yesterday, we try to keep the data on here just as fresh as we can, guys. Yesterday, there was a fresh round of inflation figures, and that's CPI, not the producer price index. That was actually today. So price gains have cooled substantially this year, but as Fed Chairman Jerome Powell has observed, the fight against inflation is not yet over. We know that, Jay. Thank you. While the inflation rate's around 4%, Powell still doesn't see it getting down to the 2% target until about 2025. I think that's true. The last mile really could be the hardest, most difficult mile, and I expect that. So, in other words, to get from 11, wasn't really ever 11, 10.6 down to 9, I mean, that's 2 full percentage points, but that's easier. 9 to 6, that's easier. 6 to 4, okay, keep raising those rates. All right, 4 to 3, a lot tougher. 3 to 2, a lot tougher. But really what the market wants to see is the direction. The market does not really care what the actual inflation rate is. Consumers care because it takes money from discretionary spending and puts it in required or staple spending. And we have to watch that as investors, because if we're investing in consumer discretionary stocks, which is one of our favorite sectors, all right, then consumers need to have the money to do that and not be spending as much as they are on food and energy. When we see those drop, that is a good sign to us. All right. Any questions in the chat? Just type it in. Okay. So I mentioned that I was going to talk about China just a little bit. They get one slide in the show. They have an inflation rate of 0. And you might say, that's great. No, it's not. Look at their producer price index. It's deflating. So if you're a producer in China and you're making a widget and you expect to sell it for, so many yuan, and then when it's finished being made 2-3 months later, you get 5% less yuan for it, that's not what you want to hear. You've got to then go back and reduce labor costs. You've got to reduce production costs, et cetera, et cetera. We don't have that problem because we do have positive inflation. We want inflation. We just don't want 11. We don't want 9. We don't want 6. 4, not really. 3, 2 in there, I'm fine. There was a time, by the way, when the Fed thought, this is back before Paul Volcker, that 3% inflation was fine. But really, ever since Greenspan going forward, their target is 2%. And I'm okay with that. But you don't want to be China right now, for sure. So PPI, I mentioned, so the consumer price index, the producer price index is what the inflation rate is for companies making widgets. The survey was for 3.3%. And it's dropped to 3.2. Again, everything moving in the right direction here. So, are we going to have a recession? Probably the most favorite question that I get over the course of a month, the timeline for recession expectations continues to be pushed further into the future. So the preponderance, or 35%, the biggest grouping of people here, thinks there's going to be a recession next quarter. We have another group that says first quarter 24, no recession in the next 18 months. All right, but the preponderance is that it's upon us here. But if you remember, when I was doing this show a year ago, we were pushing it into the future then. And why is that? Because the American economy is so strong. It is really hard for even an entity like the Federal Reserve to slow this down. I mean, there's this huge train coming and they're putting up, brick walls, the train's blasting through it. And then, metaphorically, Jay Powell is calling rent a mountain. Let's bring a mountain in here. We're going to stop this train. That is an indication of a very, very strong economy, which is great. So I got a question from Charles Todd. Hey, what's your thoughts? Jeremy Grantham called the dot-com crash and the 2008 crash warnings epic. Stock market crash coming. Well, I think you can tell from my tone, I don't see that at all. I would like to know what the data is on that. So what happened in 2008, I'm going to go back on camera. What happened in 2008 was fiscal and financial irresponsibility. This is TMI, guys, but I want to answer this for Charles. The credit default swap, you can Google that, figure out what it is. But basically the mortgages that were being sold, liar loans, people qualifying, zero money down, knowing that their interest rate was going to rise 4%. And then the homes were just, abandoned like crazy in 2008 and 2009, the ones that were sold in 2007. That's not happening now. We're not in that kind of environment now. All right. So I don't see that scenario. The Fed, for better or for worse, has a really tight control on the economy. I wish they would let up, but then again, I remember 2008 and 9 when it totally spiraled out of control. We're just not in that situation. So there will be people out there that make these claims. I don't see it in the data. And as you know, guys, I follow the data, but I appreciate the question, Charles. Thank you. Here's why the U.S. remains far from recession. The pandemic's aftermath fuels resilience among interest rates, okay? So the lingering effects of the pandemic have left consumers and employers still playing catch up. And by that I mean, you see want ads everywhere, not quite as much, at least here in Chicago, as we saw when we were living in Nashville, and probably it's changed there too. But for the most part, we still have, if not 2 job openings for every 1 worker available. It's more like 1.5. But that's still way better than any other time I've seen when we are heading into a recession. You have to have failing jobs reports to have a recession. It's really hard to have a recession with full employment. Americans are splurging on the activities they skipped during the pandemic: travel, recreation, concerts, dining out. Businesses are increasing staffing to satisfy this pent-up demand. This has been an ongoing situation. We still don't have enough pilots. We have all kinds of delays with the airlines, and it's frustrating. If you've flown at all and you got there on time, you're in about that 30 percentile that actually doesn't have a delay or a cancellation, and that's because the airlines ground to a halt. Pilots left the industry, and now they're having to bring them back, and it just takes some time to make that machine work. So these are factors: U.S. GDP, PMI manufacturing, home builder. Look at the little circle that I put there on each of them. They're turning back up. All right. So there is strength here. It may not be going as fast as we'd like, but there is strength here. As long as these indicators are moving up, it's really hard to enter recession. It just is. Doesn't mean that we can't have a down quarter, but to have 2 significantly down quarters back to back, something's going to have to change. And it's not going to change between now and my next show. I guarantee you that. Housing market. This is really short this time. So we're always a month behind here. So it's showing April home prices dramatically dropping. All right. So, but reality-wise, the seasonally adjusted prices are picking up strongly from the month prior, suggesting, at least for now, that the worst of the home price reset is over. But really, this is an area, because it's the highest ticket item for discretionary spending, the Fed wants to see collapsing home prices. I mean, it just seems crazy. But how else do you ebb inflation? You can't just say, okay, we're going to put a lock on chewing gum prices and nobody's going to be able to charge more than $1 a package or whatever. All right, you have to go after the really big ticket items. That would be cars and that would be homes. If you look at any Kelley Blue Book, any of the automotive journals, you will see that there is inventory building up on the lots. So the Fed's raising of interest rates, and if you want a car right now, you're going to be paying 6.5% to 7% depending on your credit rating. That has slowed down the purchasing, and that has aided in pulling back this fueling of the fire with inflation. And that's what they want. And they're getting that here in housing. All right. Incredibly, delinquency rates have not increased. Now, this is May data. I should get the June data in the next week or so, and I'll show you that next month too. But no serious delinquency rates, and that's a good thing. So we do the show the second Thursday of the month because the first Friday shows the employment scenario, what's going on. And there are two different entities that report payroll data. ADP, which you know, they're the largest payroll company in America. They had a shock to the upside. So their survey was 225,000 new jobs. See the highlight in yellow there? The actual number was more than twice that. Just astounding. And when the actual non-farm payrolls, that's coming from the government, came out, it was actually lower. It's unusual when these two numbers are not in sync, but we're seeing that, and that's simply the bifurcation, second word of the day. When these two important data sources are out of agreement, it's showing a murky picture. And some of this is because the Fed is tinkering with, some people would say messing with the economy, and we're getting unexpected results as they try to ebb this rampant inflation. They're trying to do, you probably hear the word soft landing. A soft landing means, oh, we just got to 2% and we're all still breathing and we're all still spending money and I didn't lose my job and my bank is still in business. Okay. A hard landing is, well, we've had 3 quarters now of negative growth. The unemployment rate just went to 14%. Well, that's not going to be 14%. That's a drama. 6-7%. All right. That's a hard landing. That's not what anybody wants. Certainly the Fed doesn't want it. And remember, this is Jay Powell's legacy on the line. So for sure, he does not want that. So last Thursday, again, that's when the employment data comes out, ADP's data showed that the private sector added almost 500,000 jobs, dramatically exceeding the expectation. And yet Friday's data was weaker than expected. So what this means is a strong labor market reflects a resilient economy, which is good news. It just makes it trickier for the policymakers who are trying to slow down the economy to a speed limit consisting of declining inflation. And I've been pretty consistent in this program showing you that the Fed has this very strange needle to thread, all right? They want to slow it down to reduce inflation. They want people to keep spending. It's like, just pretend like nothing's happening. We're going to keep raising interest rates, but nothing's happening. Keep spending, Mr. and Mrs. American, because we want the economy to be strong, but we don't want it growing too fast. I'm sorry to be dramatic here, but that's exactly what they're doing, all right? So all the angst and everything you hear on the TV shows, you let that go because they're just trying to thread this needle. As a consumer, just keep doing what you're doing. Let the Fed run through what they're doing. All right, I got a second question here. Now that many home insurers are leaving some states, do you think that rental properties may finally be available for home buyers? That's a good question, Doc. So there are multiple reasons why insurers leave states. Coming from Florida, one of the reasons insurers leave states is because hurricanes hit. The insurance companies have huge drawdowns on their asset base, and they just decide, no, we're not going to take this risk. And they don't want to offload it to Lloyd's of London or some other reinsurer like Warren Buffett, all right? But I digress. So they decide to leave a state. Do I think that rental properties, I can tell you here that rents in Chicago, in greater Chicago and downtown Chicago are near lifetime highs. And it's going to stay that way until we see mortgage rates drop. Now, I think after the last 2 days, I can tell you because I trade 10-year note futures, I trade 5-year futures, I trade the 10-year yield curve, And those traders, I'm just a tiny player in that, but those futures traders know what they're doing. And we have seen a dramatic drop, almost a crash in the 10-year yield rate. That's a good thing because it means bonds are strengthening. Interest rates are coming down. When interest rates come down at the 10-year, 30-year level, they're going to come down at the real estate, residential real estate, and commercial too, but mainly residential real estate. Good question, Doc. Thank you. So the jobs report came in lower. I mentioned that, and it's the first miss in the last 15 months. I think the Fed liked seeing that, and I don't think it's going to hurt us at all in the economy, but I think that's telling the Fed, okay, the damage we're doing is working. All right. Economic indicators. So I mention these because these are items that I'm looking at in the future. So up to this point, I go through what has caused the market to react the way it has. Why have we made the investment choices that we've had to make this month? What I'm looking at going forward is what am I going to do the rest of the summer? All right. And to some extent, that's going to be what the next 10, as you'll get to that segment, brand new one, just a little bit. So economic indicators. All right. Retail sales unexpectedly increased again. There's always a month or two behind on this data. Supposed to be negative. It actually was a positive 0.3. So that's a 0.5% swing. All right. This is more of what I'm saying. So you see the chart there. Okay. U.S. retail sales and then deflated by, inflation or CPI. So one is including CPI, the other is not. But the takeaway on this is that American spend. Just moments ago, I said, all right, CPI is based on the consumer price index, and it is GDP is weighed on 2/3 of the economy being consumer spending. That's what makes the stock market work. Now, yes, they're utility companies, yes, they're energy companies, all right, but when people spend, it goes into the discretionary sector, which is the second biggest after technology. Our favorite places to invest are technology, consumer discretionary, and communications. That would be your Facebooks and Googles, et cetera. All right. So good news from the consumer there. Consumer spending topped expectations. Survey was for 0.5. The actual number going back to April here, 0.8. I don't know why they're not issuing data, or at least I haven't found it, but we should have May's any time now, and then we'll have June's in early August. All right, good number. You see the red bar there I colored in, jumping up from the previous 2 months. And the personal consumption expenditures continuing to rise on this compendium. So I mentioned this V-shape that happened in 2020, but I want you to see how it corrected. The spending corrected and then got back on trend line. So that blue line is just a straight line trend going higher. We want higher. Why do we want higher? Been saying that. Because when people spend, companies have to make more widgets. When companies make more widgets, they sell more widgets because people are spending. And we own those companies. Their price goes up because they have higher earnings, et cetera, et cetera. And we're always looking for which of those companies is performing the strongest. All right. Now, this is one concern. I always want to be balanced in my presentations here. U.S. savings could be gone by the end of this year. So people don't mind drawing on savings to maintain their lifestyle. I am not in the business of judging whether you should be drawing down your safety net or your emergency fund to support your lifestyle. That's each individual's persuasion and proclivity. All right. That's what we have here in America. I can tell you that I don't do that. I would think most of the people on this call don't do that, but realize that many Americans do. So I'm hoping to see this slow down. It is an important datum that I track. All right. Here's another really interesting area. So why are high-powered people working into their 80s? I know we hear of the Walmart ringers and those people that are, volunteering in nursing homes and things like that. But these are actual professionals working into their late 70s and 80s. Full-time, about 300,000, part-time, about 300,000. So we're at about 600,000 to 650,000 people, which doesn't sound like that much, but when you see the next chart and the percentage growth, it's pretty astounding. Again, they're not ringing bells to welcome people to Walmart. These are professional people, management, business, financial services, sales, etc., and then drops way down after that. But these are people that have been productive, that want to stay in the business. Now they get joked about getting bored on the golf course or pushed out of the house by a spouse, but the truth is they don't want to be idle. All right, so beneath the wisecracks is a sense of purpose that refuses to fade. They just can't quit their careers. Roughly 650,000, you saw that on the previous chart, were working last year. Over 80 were working last year, according to the Census Bureau. Now, that's 18% more than a decade earlier. So percentage-wise, this is the fastest growing age demographic in America.
The idea of...
That slide is eventually going to come on for you guys. Oh, gosh. All right. So why am I showing you this? Well, part of it is I empathize with them. I have never been more excited than I am right now doing what I am doing. We'll get to that in the final segment. You guys have been watching our new methodology, our refined methodology. Nothing's brand new, but it's refined. So that's what's going on there. I think, the switcher's giving me a little, there we go. I wanted to just show you some people here, okay? So this attorney, Daniel Jaffe, continues to practice full-time at 85, probably because you can make so much money as a divorce attorney. All right. Paul McCartney, 81 years old. All right. Mick Jagger, 80. Christopher Walken, 80. I forget the lady's name here, Alice. I forgot. You were going to tell me. All right. And of course, Harrison Ford. But these two play opposite each other in that Western that is on Prime Video. All right, and of course, Clint Eastwood is in his 90s and still working. Now, you might recognize the character on the end. That is actually Keith Richard. His age is unknown, but the American Medicological Association has agreed to do a carbon dating on him to try to figure out how old he is. But he's still working, folks. All right, AI, the formidable future. What does this mean? So this is Accenture, all right? This is a really large U.S. company. They are dropping $3 billion to accelerate clients' reinvention. Launching this Navigator for Enterprise. This is a company that does not do a whole lot of new, innovative, well, they may think they do, but I haven't seen it, not reflected in the stock price. But they are going all out, talking about doubling their AI talent, not their overall head count, but just their AI talent to 80,000 people through hiring, acquisitions, and training. I think that this will lead to a lot of gobbling. So smaller companies being gobbled up by bigger companies that realize they've waited a little too long to get on this train. So if you recall earlier, I showed you the graph where here's the return of the S&P without AI. Here's the return of the S&P with AI, and it is a dramatic difference. And it's only a handful of companies. Even if it's 30, that's a handful. That's not a ton. All right? Okay, so AI will increase vulnerability of the most educated workers. Now, people think that this is going to affect the lower echelon, but that's just not true. All right? It's going to affect people all across the educational spectrum, geopolitical spectrum, financial spectrum, okay? And this is drawing a difference between those that are going to be affected with generative AI and without generative AI. So let's look at what that is, all right? Generative artificial intelligence, or generative AI, is a type of artificial intelligence system capable of generating text, images, or other media in response to prompts. So this is not just typing in something. The machine that you're typing into actually starts to get a sense of what you're looking for and suggests other questions you could be asking. So follow me on this. It's one thing for you to ask a computer something and it gives you an answer and it starts to learn, but then it starts to ask you questions. All right, that's different than just ask, respond, ask, respond. That's what computer technology has been. But when you're drawing from millions of Q&A, if you will, that's what this adaptive AI is, or generative AI is. It learns the patterns and structure of their input training data and then generates new data that has similar characteristics. This is the most interesting area to me. So again, AI stocks, I showed this earlier, but I want to show it again, drove virtually all of the S&P 500 returns this year. So the gray line is S&P without AI. The red line is with AI. Do you see AI as a threat to you as a symphonic composer? That is a great question. I'm going to go on camera with this. So, I won't tell you the name of the program because there's so many out there, but it probably wouldn't interest you anyway. But I went to this site and I said, compose something that sounds like a symphony from Brahms, but has the harmonic structure of Prokofiev, all right, with the richness of Beethoven. Give me 16 bars and do it in a woodwind quintet. 90 seconds later, I had a 2-minute piece. I had all of the MIDI tracks. For those of you who don't know what this is, all the computer tracks. So I use computer software to generate word, not only lyrics, but certainly the notation on the screen. And it generated all of that. Was it a great piece? It was not. But that's, will it affect what I do as a classical composer? Yes. Here's probably where I know it's kind of off the path, but again, it's affecting all different kinds of professions. So what I may be able to do is say, I don't want to have a melody that is too much like anybody else. Can you show a pattern recognition of what I've just done with this melody and reference that with Brahms or Mozart or Tchaikovsky? And am I plagiarizing or am I safe? So that is a really positive use without me having to have knowledge of hundreds of thousands of symphonies to be able to use. Great question. Appreciate it, Doc. Thank you. So 75% of the potential value will come from applied generative AI, will come in 4 business functions: customer operations, marketing, sales, software engineering, and R&D. Banks alone could generate an additional $2 to $340 billion from increased productivity. Read when you hear that will mean layoffs as well, okay? As the technology improves customer satisfaction, helping decision-making, and mitigating fraud for better monitoring, this is huge. The fraud component and cost for financial services, from credit cards to banking, checking accounts, etc., is enormous. And if that's all AI does, it's going to make it a safer place, less identity theft, etc. And that's something I'm really looking forward to. So this would equate to a jump in operating profits of somewhere between 9 to 15%. And I am following this. I have radar eyes on the financial sector because I think it's super important and an area where AI can really benefit us as a society. So large language models for AI, GPT, 3, 4, yeah, exactly, and Meta. So we have someone on the line tonight that knows just a little bit about Meta, and you're going to see these mega cap stock companies with all kinds of developments coming out that are going to be able to be used in their products, be able to be used in their social media, be able to filter their audiences. I think there's all kinds of implications. And if you see something that you think is interesting, and I have 2 or 3 different listeners regularly, one I know is on the line right now. If you see something interesting in AI or any other area, but especially in AI, please send it to me, all right? Because I want to know what's going on. I want to do the research, not only because I want to capitalize on it if I can, but I want to educate and inform all of you on this call. So this is from the head of public policy at OpenAI. OpenAI is the company that brought you ChatGPT and also an art program that artificially generates images from descriptions, and they have a music component too, which we just talked about. So this technology will profoundly transform how we live. There's still time to guide its trajectory, limit its abuse, and secure the most broadly beneficial outcomes. I think that is a noble comment to make. I think it's much more complicated than that. And I do finally have this short video for you that I think sort of summarizes pretty well where we are technologically wise right now with this generative AI.
The idea of robots taking human jobs might bring to mind a scene like this. But it's not hardware that has white-collar workers concerned. It's rapidly advancing software, since artificial intelligence is doing a lot more than finishing emails.
Perhaps the biggest nightmare is the looming new industrial revolution.
The erosion of the middle class, already one of America's most serious problems, could get much worse with AI if we ignore it.
Here's how AI is already taking over tasks at white-collar jobs, and why employees and companies are both excited and concerned for the future of work. Generative AI can auto-complete your sentences, write feature-length films, or organize your calendar. And tools using it, like ChatGPT, are taking on an increasing role in white-collar work. They can create first drafts of documents, presentations, images, video, and product designs. Currently, 25% of work tasks could be automated by AI in the US, according to Goldman Sachs research. Generative AI helped make this ad. And this one, too. The company advertised here said creating the image for this AI-generated ad cost about 10 times less than traditional methods.
This works much in the same way as other kinds of AI, which are using statistical methods on large amounts of data, processing that through computational power, and then generating out a computer vision system that says, this image looks a lot like these other cats that I've been trained on. Generative AI is functionally very similar.
It goes beyond creating images. Alphabet is now using AI to run anti-money laundering surveillance programs at banks like HSBC, and says it's cutting out human error.
And when the transactional data and illicit behaviors change, as they do, so does the AML AI engine.
For some tech companies, AI is contributing to job cuts. A May report said nearly 4,000 tech workers lost their jobs to AI. Artificial intelligence is also eliminating future positions. Take IBM as an example. Its CEO said the company could replace workers with AI.
I do believe that AI is going to replace a lot of what I'm calling white-collar clerical jobs. So the ones that are much more repetitive, the ones where people do the same task again and again and again, I think a good 30% of those roles could go away over 5 years.
Companies are making evaluations about future hiring on the basis of what they project AI to be capable of doing. That's a much more tenuous area.
An IBM spokesman said the company was still hiring for thousands of positions.
I think that what we've seen in past deployments of AI is that it's frequently used as a justification for layoffs, but it doesn't necessarily mean that it is effectively replacing what human workers are capable of, or that it's increasing workers' productivity.
Dropbox laid off 16% of its workforce in April, but not to replace workers. Like IBM, it said it wanted to invest more in AI, which meant cutting elsewhere.
So we see demand growing for these products a lot faster than we could have anticipated. And I think you could have seen the technology coming, but just the way that the interest went vertical is something that's way ahead of schedule from our expectations.
At OpenAI, execs say there may be more work.
I think that the kind of sum total of what is going to be needed to make use of the technology as a maximally productive technology and kind of inflect that productivity curve up in the world will actually require more man hours on top than you think.
But across industries, workers and executives are cautiously looking ahead. AI's role in television and film production is a key point of negotiations between the Writers Guild of America and the studios. Speaking to the Wall Street Journal about the strike, the co-showrunner for The Handmaid's Tale laid out the writers' union's concerns.
You know, we could tell from the negotiations that the studios had a plan, and we could deduce that that plan was probably one writer in a room with one or two machines creating an entire show.
Studios have said they're committed to discussing the use of AI with the WGA.
The WGA strike, I think, is a really important moment to be paying attention to, because it's a place where workers have taken the forefront in putting AI at the front and center of their negotiations about their working conditions.
If it's coming for us, the creators of imaginary worlds, it is literally going to come for everyone.
But there may still be time to figure out how to best integrate AI into the workplace.
So I think it's really important that in the present moment, we preserve space for a public conversation around the deployment of AI systems that ensures that they're working in the public interest, in workers' interest, and as well as in employers' interest.
So I was here in the beginning of the internet in 1993. Obviously, it began earlier than that, but that's when Netscape came out. And I remember a friend of mine showing me that and me saying, this is going to change the world. And to some extent, I'm seeing that here too. Obviously, this is building on top of internet technology, but the most prevalent word I can think of is uncertainty. All right. And people don't like uncertainty. Most people don't anyway. I have to choose to embrace it because I face that every day. You can count on us to follow what's going on in AI. And again, if you see something interesting, please send it to me. Thank you to those on this call who have sent me AI articles and keep me informed. I always read them. I may not use them on the show, but I do always read them. So the next 10, this is the second of my new segments here. We're going to look at what is going on in the next 10. In the next 10 days, starting with the banks, how will the S&P earnings hold up as 2023, that's second quarter 2023 earnings unfold? Which sectors will shine? Technology, consumer discretionary, where are they going to be? Does technology still have the ball on this bullish move, or will technology share the love with the other 10 sectors? We remember from earlier, we need to see all 10 sectors, even the lowly materials and utilities and real estate investment trusts, moving forward if we're going to have a broad-based, super bullish move here to get to new highs. If so, this promotes a much more stable, bullish recovery. That's the next 10 days. And the next 10 weeks is the summer of 2023, another third quarter with disappointing performance. Now, if you remember earlier, I told you that the third quarter is the weakest. That was among my first slides in the program. All right. Well, so far, that's not been the case. And that's why you can't sell in May and go away, or sell in July and go fry in the sun. You just can't do that, because every year is unique and different. You can look back at history, but I can't walk away from this. Just can't do it. So that's the next 10 weeks. What about the next 10 months? India is drawing closer to the U.S. Why are they doing that? Because after decades of being heavily dependent on Moscow for its military hardware, New Delhi, that's the capital, is no longer sure it can count on Russia. Gee, I wonder why. This shift comes from as Beijing continues to intermittently clash with India along their border in the Himalayas. So how would you like to be India here? You've got one northern huge entity in Russia that you really can't trust. You've got the Chinese, which you also can't really trust. Well, maybe it would make sense, since you're a democracy, anyway, you claim to be, to reach out to the U.S. Well, I certainly hope they do. They have been forced to adjust their historic position as a non-aligned nation. Not that I think they're going to join NATO, because it's not like they're in the North Atlantic, but partnering with the U.S. in a more formal way, I think can help them, and I think Washington can capitalize this. That's what I'm looking at in the next 10 months. We'll see where that goes. And in the next 10 years, these are the top 10 cities, and I was really pleased to see Chicago still in the top 10, all right? Each of these cities is expected to have $1 trillion minimum, although Shenzhen and Guangzhou, I don't know if I got that right, a little bit under that, but in this neighborhood of $1 trillion in the city, that is serious GDP. And in case you're concerned about all of America picking up and moving to the rural areas, I do not see that happening. So our methodology, I wind up the show with this. The major changes, I've talked about this and want to make sure that you understand it, happened in October 22, just not even a year ago. We will not risk any more than 1% of portfolio equity on any single stock position. It limits our position size. Portfolio growth may be slower, but more consistent. The results, which you've been watching on the screen, you'll see an update at the very end of this segment. We like where it's going. So central to this task is to discard the trivial noise of the market and identify the much more important moves. Okay, that's the trend. So the noise in the market rarely correlates to long-term significance. The foundation of our method must be to find the strongest trends, avoiding the noise, or avoid making mistakes in the noise, and then hold these positions as long as possible. We don't want to trade frequently. We want to hold positions. If anybody's concerned that this means we're day trading or trading every week or so, we don't do that unless we have losers. And we have losers, we take them out behind the barn and shoot them. That's a paraphrase from Kevin O'Leary from Shark Tank. That's not my initial words, okay? So let me go back here. All right. I'm sorry, guys. All right, so this is what I want to show you. Now, I'm going to go into more detail next month and then a lot of detail in September. This is essentially our buy-sell engine. And forget the numbers. I just want you to look at the blue lines on the top and the bottom. These are standard deviations. And again, it's not important that you understand the math. I will go through more detail over the next 2 shows, August and then live in September. But what is noise on this chart is everything between the lines. When a stock, look, this is actually the S&P 500. Look to the far left. You see how those bars are kissing the blue line there, and they just won't drop. Right? We're looking for stocks that are doing that because they're staying out of the noise of the middle of the channel. Now, eventually, they come back into the noise because the bears challenge it. But you see the bears weren't able to win, and this is in 21. Look at the bottom, you'll see 2022, and that's when things start going down. And this way, at this time frame, we come up there in those 3 green bars in March of 2022. If you look in, you'll see it there. And can't break out, and then it heads back down. So what we're seeing there is, all right, this is where the bears are in control. But continue to the right side of the chart, and now you'll see the bulls are, and they're not even able to, meaning the bears, not even able to pull it down into those blue bars. So we're looking for an extended run of these price bars, kissing, bouncing off, if you will, the top channel there. This is the essence of our buy-sell system. It's the first time I've shown you. I'm trying to keep introducing new components of this so that you understand that we have a very definable methodology to how we trade. Okay? All right. I'm not sure. I am fighting my system tonight, guys, and I'm sorry about that. Let's move forward. All right, here we go. So, process demands that we understand the market, where we are at the moment, because we live and invest in the moment. So we want to be able to predict, if we can, and I'm going to get to that in a slide or so, the shape of the market at that moment is the beginning of the selection of assets. So when I say the shape, when we see those blue lines going up and price hugging the top, kissing the top, whatever you want to call it, that's what we want to see. So grasping this moment, creating a portfolio to match that moment makes possible this methodology. Strict position size and risk is paramount. So in many things in life, some milestones are there to indicate that you're ready for the next step. Elementary school, study, you pass exams, but with trading, there's really no milestones. There's no degree from any university in trading. However, there are designations that you can get, and maybe you know of some of these. So there are currently 665,000 CPAs, that's certified public accountants, in the country. 190,000 CFAs, that's chartered financial analysts. 203 CFPs, that's for financial planning. There are only 4,500 chartered market technicians. That's the initials that I have after my name. And there's a reason for that, because only crazy people get this program. It is really, really hard. And the tests, the 3 different tests that you have to take a year apart, are brutal, all right? But it has served me well, and it's connected me with people that have methodologies that are even more refined, of these people that have been doing this for 40 to 50 years, and I've been doing it 30 plus, but 50 years with Tom Basso, you guys remember him. We're excited, never have been more excited than where we're going in the future here. So if you truly understand the methods and the probable answers to trading questions of a lot of different traders, and again, that's part of the reason I'm part of this association, decide that you're going to do it your own way, and you can explain it. So it's important to me that I can explain what I'm doing to you guys, whether you're a client and you just want to know how your money's being managed, or you want to be educated so you can do it yourself. As a seasoned trader, I want to be able to explain this in clear and definable ways, all right? So you'll get here the closest thing to an accreditation that exists in trading if you can define these things. And I will go through point by point at the September live program on how this works. So we are using AI. This is a program called Toggle AI. I've been using it for more than a year. You look in the left-hand corner, you'll see up there Adobe. So this allows me to go in and pick historical occurrences in Adobe. Look at the lower left-hand corner there, the date, 1995, 4/18, 1999, 4/26, number of trading days. The system allows me to tell it to go back and tell me what Adobe did the last time earnings beat surprised by 10% or by 15%. In this case, Adobe all three times in the top 20%, 16%, all right, over 3 months. That's a great return, obviously. Now, they're not all this good. So if I look at this next one, the next iteration, this is a 6-month return. I changed the parameters somewhat, but basically you can see, so we have the top 20%, 57% over 6 months if the same parameters follow now that happened back then. And there are obviously some losing ones too, the bottom 20% there. But what this enables me to do as your portfolio manager or educator is, I don't want to say replace staff, but I will never again employ a CFA because I can do all this research. I can have multiple machines in my office doing this and then just get a consolidated result on how would this package of stocks done over the last 500 earnings cycles. Even 3 years ago, we couldn't do that. Maybe even 2 years ago, we couldn't do it. But Toggle and other companies is allowing me to do that so I can focus on other things like risk management, portfolio size, etc., or position size, I should say. All right. Really, really important. All right. So this is where we are this year. You'll see we had this drawdown. We actually exceeded today at the market. We're returning better than the S&P. This is the new risk strategies that have come into play since I've been using the BASO methodology, which I talked about in previous programs. But we have recovered all of our underperformance versus the S&P and are now exceeding it. I know it looks like they're touching over there, but when we got to the end of the day today, we didn't. And so you can see I really had a great 20 and 21 with this huge outperformance, but then because of the lack of ideal, I guess we'll call it stylized risk management, we gave back a lot of this in 22, and we're catching up now, and I'm really excited about that. I just got to tell you that these methodologies they take a lot to implement. They take a lot of discipline because there are a lot of losers. There are a lot of losing trades. But if you're willing to say, I only want to keep the very best and take the rest of them out behind the barn and shoot them, again, Kevin O'Leary's words from Shark Tank. But that methodology is working for us in a very positive way. This is a quote I really like. 85% of my net worth is in my own funds, primarily because I believe that's the safest place in the world for them. That's where they should be. I believe I'm going to be so defensive and conservative. This is a hedge fund guy saying conservative, that I'm going to get my money back. Paul Tudor Jones, hedge fund manager, net worth about $8 billion. And my response to that is ditto. Although I'm worth much, much less than $7 billion, I have the same mindset. Risk control is now and will always be going forward the absolute essence of our trading methodology. We can still have these kinds of outperformance, the blue line there, but now we have it married to a very well-defined risk management strategy. That's the show, guys. If you got questions, remember there's about a 25-second delay. Type them in the chat. Would love to answer them for you. These will be the topics for the next, probably 6 months at least. All right. So give me your feedback. What do you like? Is there anything that's working for you, not working for you? Would love to know. The next show, Thursday, August 10th, same time, same station. The chats are back in September. It will be a simulcast, so I'll be live in front of a studio audience with a fireside chat, but I will also be simulcasting to you guys. Now, I will tell you that we're going to have to do it on the third Thursday that month of September because I want to allow a little extra time to get all the technical stuff worked out and the bugs worked out, all right? But there it is. Save the date, do a screenshot, whatever. That's the September show, but before that will be the August show, and we hope you're there for that. Remember, retirement should never be your second life. It should be your second life, but not your waiting room for death, okay? Retirement should be your second life, not your waiting room for death. And as I've closed every program for the 3.5 years we've been doing this, for we have not been given a spirit of fear, but a spirit of power, love, and of a sound mind. Guys, I hope you got something from tonight. I hope you're leaving here with confidence. That's what I want. I want you to have confidence in what you're doing in your own investments, whether I'm your manager or somebody else. I want you to be able to sleep better tonight than you would have if you hadn't watched the program. I want you to understand that we are in the most fascinating time ever in the history of the world, and indeed in America, which is the greatest country on the planet, and that we will continue to research and do the very best that we can for you. And we'll be doing that for many, many years to come. That is my pledge to you. So just please remember that at CB3 Financial, we don't just manage your assets, we become one of them. Hope you continue to have a great summer. I'll see you in August.